Money is a fundamental component of human civilization, enabling the exchange of goods and services and facilitating the growth of economies. The concept of money has evolved significantly over time, from rudimentary barter systems to complex financial instruments. This first part of the essay explores the origins and early evolution of money, focusing on how societies transitioned from barter to standardized forms of currency. The barter system. In the earliest human societies, trade was conducted through barter. Bartering involved the direct exchange of goods and services between parties. For example, a farmer might trade a portion of his harvest for tools from a blacksmith. While barter allowed for basic economic activity, it had significant limitations. The most notable was the need for a double coincidence of wants. Both parties in a trade had to want what the other was offering at the same time. This requirement made complex and large-scale trade difficult, prompting the need for a more efficient system. Commodity money. To overcome the limitations of barter, early civilizations began to use commodity money. Commodity money consists of items with intrinsic value that are widely accepted in exchange for goods and services. Common examples included cattle, grain, and precious metals. In Mesopotamia around 3000 BCE, people used barley and silver as mediums of exchange. These commodities were chosen for their durability, divisibility, and recognizability, which made them effective for trade. The use of commodity money marked a significant advancement in economic systems. It provided a common measure of value and a store of wealth, which facilitated trade over larger distances and among more diverse groups of people. However, carrying and storing commodity money, especially in large quantities, posed practical challenges. The advent of coinage. The next major innovation in the history of money was the introduction of coinage. The Lydians, an ancient civilization in what is now Turkey, are credited with producing the first standardized coins around 600 BCE. These coins were made from electrum, a naturally occurring alloy of gold and silver. Coins had several advantages over previous forms of money. They were durable, easy to carry, and had a standardized weight and purity. The use of coins quickly spread to other ancient civilizations, including Greece and Rome. Coins facilitated trade by providing a universally accepted and trusted medium of exchange. They also allowed governments to exert control over their economies through the minting of currency, which became an important aspect of statecraft and economic policy. Paper money. While coins represented a significant improvement, they were not without drawbacks. Transporting large quantities of metal coins was cumbersome and posed a risk of theft. To address these issues, medieval China developed paper money. During the Tang dynasty, 618 to 907 CE, merchants began using promissory notes to facilitate trade. These notes were essentially promises to pay a specified amount of metal coinage on demand. The Song dynasty, 960 to 1279 CE, took this concept further by officially issuing government-backed paper money. This innovation spread to other parts of the world, including the Middle East and Europe, through trade and exploration. Paper money provided a more convenient and scalable medium of exchange, which significantly boosted economic activity and growth. Banking and financial instruments. The Renaissance period in Europe marked the rise of banking and the development of sophisticated financial instruments. Italian city-states like Venice, Florence, and Genoa became financial hubs, where early banks issued bills of exchange and promissory notes. These instruments allowed merchants to conduct long-distance trade without the need to carry large sums of money, reducing the risk of theft and loss. Banks also began to offer loans and accept deposits, creating a more dynamic and interconnected economy. The development of representative money, where banknotes were backed by reserves of precious metals, added further stability to the financial system. These innovations laid the groundwork for modern banking and finance. The gold standard. The 19th century saw the establishment of the gold standard, a monetary system in which the value of a country's currency was directly linked to a specific amount of gold. Under the gold standard, governments were required to hold gold reserves equal to the amount of money in circulation. This system provided a high degree of monetary stability and facilitated international trade by eliminating exchange rate fluctuations. However, the gold standard also had significant limitations. It restricted the ability of governments to manage their economies, as the money supply was tied to gold reserves. This rigidity became particularly problematic during economic crises, such as the Great Depression of the 1930s, leading to its eventual abandonment. The transition to fiat money. The 20th century witnessed a major shift in monetary systems with the transition to fiat money. Fiat money is currency that has value because of government regulation or law, rather than being backed by physical commodities like gold or silver. The US dollar, for example, became a fiat currency after President Richard Nixon ended the gold standard in 1971. Fiat money offers greater flexibility in monetary policy, allowing central banks to manage the money supply and respond to economic conditions. However, it also requires careful regulation to prevent issues such as inflation and loss of public confidence in the currency. The evolution of currency. Currency, as a specific form of money, has played a crucial role in the economic development of societies throughout history. This second part of the essay delves deeper into the evolution of currency, examining how different forms of currency have been used, the rise of national currencies, and the impact of digital currencies in the modern era. Early forms of currency. The earliest forms of currency were commodity-based, relying on items that had intrinsic value. These included grains, cattle, and shells, which were used in various cultures as a medium of exchange. The use of these commodities as currency was driven by their durability, divisibility, and widespread acceptance. However, as trade expanded and economies grew more complex, the limitations of commodity-based currency became apparent. The need for a more standardized and convenient form of currency led to the development of metal coins. Metal coins. Metal coins represented a significant advancement in currency. The first standardized coins were produced by the Lydians around 600 BCE. These coins were made from electrum, a naturally occurring alloy of gold and silver, and featured standardized weights and markings to indicate their value. Coins quickly became popular across ancient civilizations due to their durability, portability, and divisibility. They facilitated trade by providing a trusted and standardized medium of exchange. The use of coins also allowed governments to exert control over their economies through the minting of currency, which became an important aspect of statecraft. The spread of coinage. The concept of coinage spread rapidly, with ancient Greece and Rome adopting and refining the practice. Greek coins often depicted gods and goddesses, symbolizing the divine authority backing the currency. Roman coins featured portraits of emperors, emphasizing the political power of the state. The widespread use of coins facilitated trade across vast empires, enhancing economic integration and stability. Coins became the foundation of the monetary systems in the ancient world, underpinning the economic activities of civilizations for centuries. The emergence of paper money. While coins were a significant improvement over earlier forms of currency, they had limitations, especially for large-scale transactions and long-distance trade. The weight and bulk of metal coins made them impractical for some uses, leading to the development of paper money. The Chinese were the pioneers of paper money, introducing it during the Tang dynasty, 618 to 907 CE. Initially, paper money took the form of promissory notes issued by merchants. By the Song dynasty, 960 to 1279 CE, the Chinese government began issuing official paper currency, known as jiaozi. Paper money spread to other parts of the world through trade and exploration. It offered several advantages, including ease of transport and storage, making it a more convenient medium of exchange for large transactions. The development of banknotes. The use of paper money evolved further in Europe during the Renaissance. Early European banks issued banknotes, which were essentially promises to pay the bearer a certain amount of gold or silver on demand. These banknotes were backed by reserves of precious metals, providing a stable and trusted form of currency. Banknotes facilitated the expansion of trade and commerce by providing a reliable and portable means of payment. They also allowed for the creation of credit, as banks could issue more notes than they had in reserves, based on the trust that not all note holders would demand redemption at the same time. National currencies and central banking. The 19th and early 20th centuries saw the establishment of national currencies and the rise of central banking. National currencies were issued by governments and backed by their authority. The creation of central banks, such as the Bank of England in 1694, marked a significant development in monetary policy and economic management. Central banks were empowered to regulate the money supply, stabilize the currency, and act as lenders of last resort during financial crises. This period also saw the adoption of the gold standard, where the value of a country's currency was linked to a specific amount of gold. The gold standard provided a high degree of monetary stability but also limited the flexibility of monetary policy. The end of the gold standard. The gold standard began to unravel during the 20th century, particularly during the economic turmoil of the Great Depression. The need for greater flexibility in monetary policy and the constraints of gold reserves led to its abandonment. In 1971, the United States officially ended the gold standard, transitioning to fiat money. Fiat money is currency that has value because of government regulation or law, rather than being backed by physical commodities. This shift allowed governments to manage their economies more effectively, although it also introduced new challenges, such as inflation control and maintaining public confidence in the currency. The digital revolution. The late 20th and early 21st centuries have witnessed a profound transformation in the nature of currency, driven by the digital revolution. The advent of electronic banking, credit cards, and online payment systems has revolutionized the way people transact and manage their finances. Digital currency exists only in electronic form and is used for online transactions. The proliferation of the internet and mobile technology has made digital payments ubiquitous. Services like PayPal, mobile banking apps, and contactless payment systems have made transactions faster, more convenient, and more secure.